G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. If I can get the words out, I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here, as I have every week, with Chris Bates from the Alcove. G'day, Chris. How's it going?
Going well, Pete. I'm not sure what you've been up to, mate, but just hanging out in Sydney last weekend. My 3-year-old boy is out of control. If any listeners got any help for me, please send it through. Had to separate them on the weekend. My daughter's just turned 5, and Daddy Day, Mummy took Ellie, and we went in separate directions because the fighting was intense. But it was all right. Took him to dinosaurs in Western Sydney, or at the Olympic Park. Spent $40, went around in 15 minutes, then thought, right, take him to the pool. Took him to the pool at Olympic Park there. Finally, it was chaos because it was 36 degrees. It was like being in a mosh pit. And then finally about to get into the pool and everyone's leaving. I said, what's going on? He said, oh, someone's vomited in the pool. So I had to get him out of the pool. And then finally took him to the movies, and he sat there and watched a movie, which I was shocked by. So that was my Sunday. What have you been up to, Pete?
Well, that's well outside my circle of competence, but I do remember the terrible twos with my daughter. In fact, I was down in Brisbane this week, and it reminded me that when she was 2, we actually got kicked off the City Cat once. She was making such a drama about, she was kicking and screaming, and we're actually asked if we could actually get off the ferry. It was that bad. But then when she turned 3, it just stopped in a day. So I think with boys, maybe it goes on a bit longer, that testosterone thing. I'm not sure. But this is way outside my circle of competence. So, So what have I been up to? Well, on a similar note, I was down in Brisbane for the HIA State of the Nation sort of industry day this week. And we took the opportunity to go to Bluey's World in Brisbane because the kids obviously love it. And it's down on Hamilton North Shore there, where the new apartments are going to go in ahead of the Brisbane Olympics and the Olympics Village. And they're pretty good entertainment. But as I said, you pay your $40. You want to stick around for a while because it's a 1-hour guided tour. Then you get to hang out in the merch and the cafe area for as long as you like. So pretty good if anyone's thinking about it anyway.
Oh, no, you've stoked an idea for me there. I'm definitely going to go there. We're going out to Goldie for Easter, to the White Cliffs of Gold Coast, I guess you call it now. But that should be Bluey's World on the cards now. I mean, what should we talk about this week, Pete? I mean, there's lots going on. I mean, I would say from a work point of view for us, surprisingly, we're actually a bit quieter than I expected. It's usually quite a busy time, sort of March, April for us, in the midst of autumn. People see properties that they've been sort of haven't seen for a while. Good stuff comes on, and then that usually, encourages people to sort of reach out. But a little bit quiet. I think people are a little bit tempered. They're just not sure how many rate cuts are coming. Maybe they want to see a few more in the bank before they start to get a bit of FOMO. But I guess a few of the stories we're going to talk about may even contradict that. So, but that's just what we're seeing on the ground. It's not as busy as usual starts of recoveries, I would say. Busier than before, but not as busy as I would say in 2019 or 2014, 15. There's been some other times where markets have really kicked on. So, what about yourself, Pete? What's happening at work?
Very similar. I'd say we're steady, but not manically busy or anything like that. So, I think the general vibe seems to be that with the cash rate target where it is, it's going to take more than one rate cut to move the dial. I think it feels like, yes, it's improved sentiment, but it hasn't really improved borrowing capacities very much at all just yet. So that's a factor. I think the supply issue is still ongoing. Actually, the HIA event, there was Matt Canavan, the senator, presented, and he talked about Zipf's law, which you probably covered on the elephant before, where it's sort of the big cities tend to attract the bulk of the population, and with the probable exception of Queensland, where we do have quite a lot of regional cities, Australia is very heavily centralized, and that's a big part of the supply challenge. And your old friend Tim Reardon, the chief economist of the HIA, put out his latest forecast for the government's 1.2 million homes target, and not that surprisingly falling quite a long way short, and particularly in Sydney. I think they pointed out that unit commencements in Sydney were the lowest in 14 years last year. So, and I suppose the other takeaway I took from Tim was that although with an election coming up, both sides of politics will talk about dampening immigration, but in practice, it might not be that easy to do. I think the ABS figures showed this week that over 200,000 students arrived in February. So that's 15% more than we would have seen in the pre-pandemic period. So yeah, got a 40-odd thousand views on Twitter when I put that stat out there. So obviously a lot of people are feeling that chronic shortage of housing, particularly in the rental market, but it just hasn't gone away. The issue is still bubbling along.
Yeah, I think this underbuilding is going to stick around for a while, which is one of the stories we're going to cover today. I mean, one of the things, I'm still getting used to, I'm not sure about you, Pete, is when the RBA meetings are. I mean, so it used to be nice and easy, first Tuesday of every month, and you just sort of not have to think about when the next one is. But, next one's on the 1st of April, then the 20th of May, the 8th of July, 12th of August, 30th of September. So they're all these random days. I mean, how you keep track of it. But I reckon you need to see two more before, even one more rate cut's probably not going to change much, right? But if people start to see 3 or 4, we're going to start to get a bit of a roll on. And so, I mean, if you look at ASX tracker, I think we're looking maybe it's September. So, that maybe the second one comes, so 30th September. I mean, that's already into the spring auction market. I mean, if there's expectation in August that it's highly likely, maybe that would be enough. But yeah, so we might even see that, even at the tail end of this in the spring period, people are still very hesitant. I mean, I've been doing lots of property strategy calls with clients, and a lot of people's natural challenge right now is just borrowing capacity. And they'd love a house, but they can only afford an apartment. They've already got an apartment, and they'd have to sell that to buy something, and they can't get what they want. And work's going well, but they just really need more borrowing capacity. They've got no access to intergenerational wealth, and they're kind of just holding that, and they don't really want to enter the market to something they don't want because rates are really high, and they don't really want the mortgage. They're sort of happy enough where they are. But once markets start to run on them, they'll go, oh God, we actually do need to make these compromises. And I think people need to be forced their hand a little bit. And similarly, I think a lot of investors are holding on to their properties because they're like, well, market's still not ideal. I'd rather sell the property in a stronger market. And so you see this natural supply restriction of investment properties. But yeah, let's crack on with these 3 stories. What do you say, Pete?
Yeah, I think, as you said, I think if the market pricing is for 2 or 3 more cuts in this cycle, taking us down to a neutral nominal cash rate of 3.5% or thereabouts, maybe a touch lower. Well, I mean, that if you're borrowing at maybe 5.5, that's it's just a different ballpark from borrowing at 6.5. And maybe if you shop around, you might even get a better rate. And if APRA reduces the lending assessment buffer, well, maybe that puts some sizzle in the sausage. But at the moment, yeah, still, it's a stretch for a lot of households, I think. So although the cut has changed sentiment, particularly in Melbourne, as we'll talk about in this first story of the week, yeah, maybe I think elsewhere people are still feeling the pinch of those higher rates. So let's take a look at the 3 stories of the week. Stick around though, because at the end we're going to do our 3 listener questions. So do send in your questions. We'll try and cover 3 or 4 of those each week. So we'll do those at the end today. First news story of the week from the AFR and also covered in macro business. Bargain hunters make a Melbourne move. So I'd say often we've seen in previous cycles in Australia that the cheapest capital city has often got had a bit of a tailwind, I suppose. So Hobart was a major beneficiary of that, and then Adelaide, and then Perth. But I mean, I suppose Melbourne technically isn't the cheapest capital city. I think Darwin would probably take that mantle, although you could sort of argue that Darwin acts a bit more like a regional city more so than a capital. But yeah, I think alongside Hobart, I mean, the median dwelling price in Melbourne certainly has an affordability advantage over Sydney and Brisbane now, I would say. Yeah, I think that relative affordability is bringing the buyers back, especially from interstate as well. I think Westpac's consumer sentiment survey saw a massive lift in Melbourne and Victoria for the time to buy a dwelling, also house price expectations. So positive territory there. And I think even CoreLogic's monthly figures for March will probably show Sydney and Melbourne actually in positive territory. So it's a pretty instantaneous reaction, I think, to lower interest rates. Are any of your clients making noises in that direction, Chris?
Oh, I'd still say very early from the upgraders. First-time buyers are always active in the market, and it's very consistent the amount of that enter the market every year. And sometimes they have good times, but sometimes they have tough times when they're competing with a lot of investors. But I would say so they're always in and out of the market. But I'd say investors and upgraders are a little bit more flippant. They sort of go when they need to, and I would say upgraders are very lackluster and I think Melbourne does make a lot of sense. I think a lot of people have, even though because prices haven't run and borrowing capacities have fallen a lot, people can still get, things that are going to suit them long term down there. And I think there is a little bit of concern that if they don't buy now, then prices are going to run on them. And so it's right. A lot of other cities around the country, prices have already run. So people are, less, I guess, scared of prices running because they already see it as affordability challenges. But Melbourne, I think, chatting to Kate Bakos just a couple of weeks ago, we had her on the Elephant, and yeah, she was absolutely saying that it's been a flick of the switch compared to late last year, and she could see that all the way through to January. Not just first home buyers and upgraders, but also a lot of investors, which is surprising given land tax rules and anti-investor they've been down there. In saying that though, I also had Simon Presley on the podcast a couple of weeks ago, and he's so anti-Melbourne. He goes, how can the city do well when the economy's in the toilet or something like that, he said. So, but I don't think I agree with that. I think Melbourne, the reality is economy could be struggling, but people are still out there buying because their industry and, where they work is still doing quite well. And they can afford to buy and they want to stay in Melbourne long-term and they're trying to buy a long-term asset. So, sometimes, property markets aren't always interlinked to the economy. Economy could be, struggling. It could be a recession, but prices could go up. You could look at COVID as an example of that. So, that's my take on Melbourne. I think it is, primed for growth, but we've been saying that for a while, but I don't really like to forecast, but I do think it's got the fundamentals right.
What about Flick of the Switch? AC/DC lyrics mentioned. I'm going to change the podcast title there. So that's I will have Flick of the Switch for Melbourne as the lead this week. Let's hope we don't get shot down in flames, or actually maybe Highway to Hell for the airport link would be somewhat germane. But I think your point. CoreLogic actually put some stats out. Past 5 years, nominal price growth per 76%. Adelaide 74%, Brisbane 70%, and then Melbourne right down at the bottom of all the capital cities, 8%. So it's not that it's been terrible, but relatively speaking to every other capital city, there's a huge differential. So it kind of makes sense if you're a contrarian or counter-cyclical buyer that Melbourne would obviously be, of the capital cities anyway, the place you would go to first. So it seems like potentially the bargain hunters are moving in.
Yeah, absolutely. I think let's watch this space on Melbourne. Let's crack on with story number 2, Pete.
Yeah, so I just called from a Facebook Live on Saturday evening. I was sort of catching the football on Saturday, but I sound like yourself. I have a quick squeeze at the auction results on Saturday night, and I saw the auctioneer Tom Panos, who's Sydney-based, did a little 5-minute video which we'll link to. He said he sold 12 out of his 13 auctions under the hammer on Saturday, including some pretty big results actually for the Inner West. And he said this is just the first signs he's seen of FOMO, or that fear of missing out in Sydney. He gave maybe half a dozen reasons why that might be the case. I think lower interest rate expectations is clearly one of them. Big population growth, another. That that we've already touched on. I think a big thing is the high cost of construction. I've got a maintenance guy coming out here today. Now, this is Queensland, not Sydney, but it's $1,000 for a day rate now. So there's nothing cheap across the industry. Something that the Housing Industry Association also talked about this week. And Tom said that the cost to build a unit in Sydney, maybe 5 years ago would have been, say, $350K. Well, now it's $550. It's a massive increase, and I think that as we've talked about previously, it's just not that attractive for developers to get into the space at the moment, given that cost increase. So he thinks that older units are going to fly, particularly if you're looking at places like Inner West or Northern Beaches or Eastern Suburbs, those sort of boutique unit blocks. And Yeah, I mean, his overall market wrap, which you can watch for yourself with the link, is that the market in Sydney is most likely back on the up in 2025, not dissimilar to Melbourne. And I think this just goes back to CoreLogic's research that when interest rates are going up, people tend to go out to the cheaper markets. But now, the other side of the cycle, when interest rates are coming down, they probably head back to the most expensive cities again.
Yeah, I mean, I think I remember just at a kid's birthday party, I was chatting to a local builder up here, and we were just discussing, how much building prices have gone up, and it's great birthday chat when the kids are terrorizing each other. But we were having a chat, and I said, "Look, your price is going to go down." He's like, "There's no chance. We feel like we've been running on such tight margins due to competition, and haven't been able to take too much profit. And so now finally we've been stung over COVID. Our prices have gone up, and we'd really want to protect and build our buffers up again." And a lot of builders are saying the same thing. I think I also saw a charter Keck Kramer report this week, and it's pretty enlightening, this reading. It's another thing we should put in the show notes. But if you look back at 2014, 15, 16, we were just launching apartments or commencing apartments, not just trying to sell them, but actually building them, starting the builds. I mean, in Brisbane, it was a few years of 10, 12, 14,000 apartments every year for 3-4 years. You're lucky to get 2,000 new apartments up in Brisbane right now. Sydney is very similar, circa 25, 30,000 for, good 4 or 5 years there from 2014 to 19. Lucky to get 8,000 commencement at the moment, nowhere near the numbers. And Melbourne, which was, high-rise heaven, I guess you'd call it, from 2014 to 19, 15 to 20,000 every year, lucky to get 3,000 now. So we're just not, building at the moment. And a lot of competition for resources, whether it's the government spending and infrastructure or just the international market. And I wonder how this is just going to turn around, Pete, because, I mean, the cost of construction has lifted. So does that mean that prices have to rise to be able to sell them? And I think that's the case. And so what's going to have to rise is established stock, because it's worth more now, because to build what's currently out there is going to cost a lot more. And land's gone up, but also buildings have gone up, and older buildings worth more now than it was, say, 3 years ago, because the cost to replace it is much more. And so, and that's going to make it harder for developers to buy the land, because often they have to buy land that has established stock on it. There's not many vacant blocks around. So, it's a real, tug of war at the moment to build more apartments.
Well, it was one of the things that came up at the industry event is the international market was one thing that you mentioned. And I think any government that wins the May election, that's an easy win if they want to boost supplies. Take the stamp duty surcharge off for international buyers, because you'll get new apartments, more pre-sales, more construction, more supply. I know that there's a move to take international buyers out of the established market, and that's fair enough. But if you actually want to get stuff built, then having a surcharge for international people who would like to buy a new townhouse or new apartment, that doesn't really make sense. And the other thing is, there's been a lot of talk about falling productivity in the construction and development sector, but it's not really properly measured. This is something that Tim Reardon pointed out. Today, if you're building a new unit block at, say, Barangaroo or something, it's probably a 7-star environmental rating. And there's so many pieces of red tape as well that overlay that. You've got to have a modern slavery policy, Indigenous engagement policy. You've got to have health and safety policies that are infinitely more stringent than they used to be. Whereas if you went back, say, 50 years ago, what were we building in Australia? Really weatherboard shacks by comparison. So a lot of times people talk about productivity being an issue, but it's really a change in the composition of the stock that we're building. And it doesn't come cheap. I guess that's the challenge. So, I think, all of I read the Charter Keck Kramer report, some of my favorite analysts, actually. And it doesn't look too bright. It's a bit of build to rent happening, a bit of build to sell, but still, we're not really going to be close to the government's targets. So, just a kind of an ongoing challenge for Australia, I think.
Yeah, you just reminded me of another article I read this week on the urban developer. I know I've raved about this site before in the past, but there was an article on there which referenced HI as well, and basically showed how much taxes, half the cost of a new house and land package in Sydney goes on taxes and regulatory charges. And so, a lot of people just don't understand that. And, really the government's making so much money on new housing stock, hence why we've got the system we do. Everything from the council to, stamp duty, development taxes, the GST, it goes on and on and on, and the contributions you have to make when you're building developments to local infrastructure, which makes a lot of sense, they've gone up so much as well. And so I think, one is reducing stamp duty for foreign buyers, but I do feel like this is that's why the government gives, homeowner grants, because they're making way more than that in taxes, and hence why they do no stamp duty for new builds and things like that, because they just want to, support the development industry firstly, but also make the money on the taxes. I'm not sure if you got thoughts on that, Pete.
Well, for sure. I mean, there's also a big multiplier effect across the sector. For every dollar that's spent on residential construction, you're really getting $3 of output in the economy. So, of course, governments are quite keen to get people in. I think stamp duty has become a real obstacle, not just an Australian problem. I know that the leader of the opposition back in London, Kemi Badenoch, is saying that stamp duty is just stopping people from building, stopping people from moving. They'd rather stay put and try and make do or renovate, but it really gums up the housing stock, and also it's not good for labour force productivity if people won't move to where the jobs are. So yeah, I think I mean there was a lot of debate online about how accurate those taxes figures are, but because how do you allocate? You've got infrastructure charges and then the GST on new builds and so on. But I think any developer would say it's not easy. When you actually add it all up, there's a bit of double taxation in there potentially. It's definitely there's probably too much red tape and too much in the way of tax. I think that's inarguable. So let's look at this third and final story for the week before we go on to your listener questions. Kiwis flee New Zealand for Australia in record numbers. I saw Stats NZ put out their figures over the year to January. 122,800 New Zealand migrant departures. So that's one way to get a cheaper housing market, get everyone to leave in a recession. Certainly seems to have worked a bit for Auckland. But so over the financial year, there was a net migration loss of over 30,000 people to Australia, including 47,500 migrant departures from New Zealand to Oz, and then a few going back in the other direction. So I mean, this is I think a consequence of New Zealand's economy, which has been in a downturn or a slowdown. That's impacted the property market. I see 15% of New Zealanders now live in Australia, which is an incredible stat. I think we've got Guy Smith, who works with us in the team. I think for aspirational young Kiwis, the income differential is the big driver. I think you can certainly earn more money on the Gold Coast or in Brisbane, which popular locations for Kiwis to move to. It's like the New Zealanders' dream for a lot of people. And you can earn more money. There's bigger head offices in Sydney and Melbourne potentially. I think there's a bit of an argument that some of the people coming to Australia might be sort of backdoor migrants, if you like, who've migrated to New Zealand, then got the reciprocal citizenship or residency for Australia, which is an interesting point I hadn't thought much about. But yeah, we do see this quite a bit across southeast Queensland. You hear a lot of Kiwi accents around, and sometimes things go the other way. Like when there was the Christchurch earthquake and rebuild, and there was a shortage of labour over there. But it seems now all of the flow is back towards Australia.
Yeah, I mean, that kind of contradicts also one of the other articles on your blog, Pete, where you basically said that a lot of Aussies are now potentially moving overseas. I mean, the brain drain is real, right? And a lot of cities struggle with this around the country where better job prospects are in the cities. That kind of goes to your first point around our law that, a lot of people get sucked to our capital cities. And it's very hard in Australia to create new cities. And we can't just create. We've tried that with Canberra, but we know it's hard to create a 5 million person city. And with a lot of our investment is just making our cities bigger rather than infrastructure to create bigger regional towns, I would say, or their sister cities. You mentioned about Queensland, that's not the case, but really when you add in Brisbane, Sunshine Coast, and Gold Coast, well, that's probably a big portion of the overall population. So. What was your stats you saw with people, Aussies now moving overseas again? It seems like we've got the confidence to explore the world a bit more.
Yeah, so once a month, the ABS puts out overseas arrivals and departures figures, and yeah, I mean, just as we saw with arrivals, there was kind of a massive drop in 2021 and 2022. Effectively, nobody was leaving because the borders were shut. Over the year to January, we're practically up to a record high, nearly 700,000 permanent and long-term departures. I mean, that's against over 1.1 million arrivals. So there's some pretty big movements, and you can get some double counting in those numbers because those relate to border crossings. But if you think about where Aussies are going to, I mean, obviously we've mentioned some of them go to New Zealand. United States has been popular because the US dollar is now potentially quite a lot stronger. So if you're going over there to earn US dollars, that's popular. UK has become more popular again. There's also other parts of Europe, places like Germany, Spain, Greece, Singapore, Dubai. I think Hong Kong is less popular than it was now. So yeah, I think I mean, it was obviously there was a period there where nobody could go overseas. Now we're getting our mojo back, and maybe the lower Aussie dollar just makes people think, well, if I could go and earn some money in a stronger currency or maybe in a lower tax jurisdiction, and then potentially I can send my money back to Australia in 2 or 3 years. So yeah, I think over the year we still had sort of a net immigration figure of 432,000. So it's still massive, but it's just a bit less high than it was. I think at the highs we were about 13% higher than that. So yeah, it's always interesting to see where people are going in the world and what they're going to do for work.
And I think that's what Sydney in particular, has to be very concerned about right now as a society. Do we get the brain drain if people can't afford to buy houses that give them, inspire them and want them to live in the city long term, and whether it's renting or buying or owning, people are going to leave. And you already see there's already natural interstate migration out of New South Wales to places like Queensland, etc. But do they start moving overseas? And particularly if the Aussie dollar is not favorable, I might as well go work in the UK or Europe or the US. And like you say, bank some money, because staying in Sydney is just not an option. It's not, the cost of living, there's no housing options. Well, we might as well just travel the world. And I think that's not great for our society and productivity and, innovation, etc. So I think that's the real social issue Sydney's got ahead of it. Right, let's crack on with some stories, Pete. What do you say?
Right, 3 listener questions. We'll try and get through a few of these. So first one from new to investing. I'm working FIFO in Western Australia. Got my mortgage. I really didn't want to invest in property, but I've since had a change of heart as I would like to set myself up financially. What are your thoughts on buying older houses with large blocks and converting them into duplexes, triplexes, or units? I was thinking I could possibly sell one to cover the costs and keep the other couple as investments. I think, well, firstly, I think it's brilliant that you're thinking ahead about your financial future. I've lost count of the number of clients over the years who've gone to work on Gorgon project or one of the other FIFO projects like Inpex or something. And then at the end of 3 or 4 years, they've got a couple of jet skis and a new Holden, but not really invested for the future. I think it's a great thing to invest while you've got that strong FIFO income. I would say, I mean, like, not against the idea. I think if you're working FIFO, though, managing a development at the same time, especially in the current environment, might be difficult, especially if you've never done it before. It might be better if you can hold property and sustain the negative carry or the negative cash flow. It might be better to buy something with development potential and maybe come back to it when you finish working FIFO. Just think in the current environment, building costs are high, so the risk of cost overruns is particularly acute. But also a lot of developers are going insolvent, several thousand last year. So I think there's a few risks if you're trying to manage a project remotely and it's your first one. What would you advise in that situation, Chris?
Oh, look, I mean, going straight from zero to hero, and doing multi, dwelling developments is definitely ambitious. And I like you say, it's definitely doing something for your future. But a lot of your money you make in property just by buying the land, right? And buying in a city that's with scarce land and high quality lands. The problem I see with people going down the duplexes and, 3, 4, dwelling, apartments, etc., is that usually they're buying land in other areas where other people are doing it. And so what ends up happening is you buy in an area where you're probably already paying inflated price because everyone else is looking at the same opportunity. Then you go and build them and so on. Someone else also builds them. And by the time you've actually finished them, oh, hang on a sec, there's no longer an undersupply of these, there's an oversupply. In saying that, I have seen people do extremely well out of buying blocks of lands and building a duplex, but they really need the market momentum to be in their favor. So ideally, people buying, duplexes, not the ones who are developing it, the actual one buying the finished product, are buying that because they can't afford a house. So that's their second alternative. They love the house in the area, but if they can't afford that, they buy the duplex. So I think the time you make the most money on that is when the housing market runs really hard, and then you supply an undersupplied housing market with a nicely finished duplex. And so really you want your finished product to be at the top of a housing group. And that's really quite hard because you've got to really time it. And so I would say in this situation, whether you buy an older house that's rentable in an area that you're going to renovate the house long term, that's probably a decent strategy. But or you could buy a bigger block that maybe has development potential for a duplex, but you buy it in an area where there's not that many bigger blocks, and you're buying in an area where it's maybe going to try to do the duplex at when the housing market's running, rather than doing it straight away. So I'd just be accruing some land right now. And rather than also the cost to go and do a duplex, etc., like that. Yeah, I mean, you're going to have to find the money somewhere. So let's say you do find a bank that's willing to lend the money to you. That money that you could have meant you got another block of land somewhere else. So you've might have been able to buy a block of land for $1 million. You might need a 1.5 for a build, or $1 million. You could have then just used that and got another asset as well and had 2 pieces of land growing for you versus just 1 piece of land trying to manufacture some growth. So hopefully that was helpful.
I think so. Like on a risk-adjusted basis, if you buy and develop straight away, as we already talked about earlier in the show, the margins aren't great across the industry.
Yeah.
You may be better to land bank an asset or two and then potentially come back to it down the track. Don't have to do a development straight away. So second question, help a mama bear out. I'm now renting out my home as we've moved towns. It's 3 years since I purchased it and the value has gone up by a good 300,000. Do I work out the rental yield based on the original purchase price or the current price I could sell it at now? I'm trying to compare if the investment, if sold, is worth moving to shares or not. So is the rental yield a direct match to the estimated yield from shares? So bit of financial jargon for you here, but there's really 3 different things. Firstly, the rental yield when you purchase the property, that's like a moment in time. It's a spot figure. So it might be a 3% or 4% rental yield from the purchase price. Then you've got the rental yield based on today's price, but you've also got a third thing, and that's the rental income that you're getting today. And I would say if you're looking forward, you're looking prospectively at what's the best opportunity, you would probably compare the rental income you're getting today versus the potential income from a stock portfolio. But of course, the income is only one component of your returns. The other thing is capital gains. So you need to make an assessment. What's the outlook for your property? Has it already seen its growth for this cycle? And therefore, that might be a time to recycle some of that equity into another asset class. Or do you think it's still got growth potential for the future? I think the stock market, as we talked today, is not cheap, but it is off the highs. So, what would you say there, Chris? I would say I'd calculate all 3 figures, but you really need to compare what you've got today versus the perspective or the potential returns from another asset class, because it's the future that we're most interested in.
I do have to say, I absolutely love this question. And because you're thinking about things, I guess not one-dimensional, right? Oh, it's worth $1 million now, and I can rent it out for 40,000, so the yield's 4%. Like, and it's that's simple, because and it actually gets a little bit more complicated the more that you dig, and that's why making a decision whether to hold or sell is actually quite a complex decision. And what ends up a lot of people do is, because it is complex, is they don't do anything. And so just being a bit strategic and saying, I've got to take away the emotional attachment here, and it's done quite well. So the temptation would be just to hold it. But what you should always be doing is looking at your, independently looking at your portfolio and saying, look, is that really the best decision to hold it or not? That whole idea of just buy and hold forever, I think sometimes you need to look at things and make a decision. You know what? It actually makes sense to sell. But you really need to, if you are selling, I think you got to think, what's the world look like if I do sell? What am I going to do with that money? Like, what's the opportunity cost? And so, for example, if you're going to sell that property and you lived in it and maybe those gains were tax-free. Okay, great. Okay, so then you've got, what would be your net equity that you're going to walk away with? What would you do with that money? Okay, well, I'd pay off my home. Okay, great. So you've got a guaranteed return of your new place of 6% after tax on that money because you're going to pay off your mortgage on that place. Okay, well, what would you do with the extra borrowing capacity you take? Well, I'd use that to buy another investment property. Okay, great. So you've got the growth on that property, and potentially you could get a better property, for example, if it's not a great asset. And like you said, Pete, where it's in its natural cycle is a big part of that decision, because there's no point selling a poor asset in a poor market. But if it's a good asset and it's a good market to sell, or it's a poor asset and it's a good market to sell, then you might say, hey, you know what? Let's just take money off the table here. I don't think yield's a funny one as well. I mean, there is a temptation to do it on first purchase price, and that will make you feel good because naturally yields should increase over time. Every time rents go up, your yield on purchase price should go up. And a lot of people don't sort of think about that with properties, that, yeah, okay, I'm only renting it at a 3% yield today, but what happens if rents go up 30% over 3 years or 5 years or 10 years? I mean, your yields on purchase has gone from 3% to 3.9%. But on the current value of that property, it might still just be 3%. So that's a really good question. Also with property, though, yield can get eaten away pretty easily through costs. Every property's got different costs, whether it's an apartment or a house. You've got strata, you've got building insurance, you've got maintenance, you've got real estate agent fees. The list goes on. And so you've got to be really careful that, I think you should be using yield after costs, because that's really the yield you're getting. Those costs are there. You can't really run away from them. And so if you've got an apartment and you're, for example, renting it out for $500 a week, but you've got $100 a week of costs, well, really you're only getting $400 a week in your pocket. And I think that's the yield you should be using. So the real good question, I think you really got to think about, what would I do if I sell? And is that a better world than holding it? And it's a tough question to answer.
I think, yes, you're right. So, yes, using a net yield after cost probably makes sense. Also, if you do sell, there are transaction costs. So you might pay a significant chunk in capital gains tax, which is also something to factor in. One of the things that people like about residential property is that it's kind of a perpetual asset. You can just hold it forever if you want to. And it very often turns out to be a good long-term investment if it's in a good area and things do seem to be working for you. So, maybe a refinance is a different way to think about it. Okay, third and final question for this week. Who's the best person to speak to, accountant, broker, or advisor? I listened to the recent podcast Owen and Chris did about buying a dream farm. I've got a scenario for you. I've got a place, I won't go through all the specifics, but I've got a place of residence in New South Wales and also an investment apartment. I'm holding tight for now, but I can't help think my apartment is not going to increase in value more than the amount it's costing us to hold, plus the interest paid on our purchase place of residence in the same time frame. So potentially, is it better to sell the investment apartment now? I guess this is not dissimilarly a question about opportunity cost. It's you've got a limited amount of capital to invest. Is it best to hold it in an apartment which is ticking along, or is it better to take that money off the table and get it into your dream assets sooner? I've spoken to my accountant, broker, property manager, and financial advisor, and all of them seem to point to another one no one seems willing to discuss. That is a problem with property, because to a certain extent, anyone can give advice, but then on another level, no one seems that keen to give the specific advice. So, what would you say there, Chris? Would you bite the bullet and sell the apartment, or would you hold tight and wait for a bit of a growth spurt?
Look, I think
it's in the inner west of Sydney, I should have said.
I think you've hit on a key point that is a bit of an elephant in the room. Who really gives good property advice? And I think everyone's conflicted, and this is sort of in some way. An accountant's going to probably look at the tax there and go, if you sell it, you're going to pay a lot of capital gains tax. Okay. that's great. Might be happy to pay capital gains tax. That's fine. An advisor would always be conflicted, and this is we work with a lot of financial advisors, and I was one. They are anti-property, generally speaking. If they don't anti-property, they just naturally don't want to advise on it, and then they potentially can't with the dealer group they're licensed through. And so they'll probably just say, let's just keep it there. It's simpler for us not to discuss that. And if they do, and a lot of them that don't understand property, if they do understand property, they don't really understand it probably to the degree they should. And they build partnerships with the wrong people. It's just, unfortunately, they fall for things like depreciation and buying off the plan and new property. A lot of advisors just don't understand that, if I'm honest. Brokers are a funny one. They don't really want to step out of their lane often, which is sometimes a good thing. And so they won't really want to say, sell that, because they don't see themselves as sort of trusted advisors. They'll just probably look at the debt and say, it's easier for me to refinance it and get it on a better deal. That's just naturally how brokers think. So you can, and if you go to a buyer's agent, a buyer's agent say, get rid of that and I'll buy you another one. And so they're conflicted as well. And that's just me being a little bit, true about the challenges of conflicts of interest. I mean, the reality here, it goes back to our last question. Really, if you look at this and go, well, if I sell that apartment, what would I do? Okay, so I'm going to release some equity here. You might have, 300 grand after tax. What I would do with that 300 grand is pay off my home, so I would have less home debt. Now I've got less home debt. Have I got equity in that home? Yes, because I paid it off, plus I had other equity. I'll redraw that equity. Can I go and buy another investment property and have a fully tax deductible debt on that and less home debt on my home? Could I use that equity to buy some shares? Does that mean my mortgage is cheaper for me and makes me feel less stress about my mortgage and gives me more options with work? So it doesn't mean you have to invest if you sell, but there are benefits in doing so. And I would say that's what you just really need to think through. Is that a better world if you sell versus holding? And something you can never get away from capital gains tax. I mean, preferably you prefer not to pay transaction costs, because it's money that just vanishes. Whereas I'd rather have that money invested, growing, and then pay tax on the growth, and delay paying tax and delay paying as much stamp duty and agents cost as possible. But sometimes it's better to sell, bank it, and then go get a better asset and restructure your debt in the process as well. Because and 100 grand of restructuring debt doesn't make a difference, but 300 grand might be 10 grand a year more in your pocket, which is getting worse every year for you. And so sometimes you have to go and do a sell to buy again, if it
I'll
makes
throw
sense.
in one more point there, Chris. And that just goes back to Tom Panos's point. I haven't seen this unit, obviously, it's in the inner west, but purchased for 735k in 2016. Today's valued at about 850. If I sold, I'd only really take out what I put in. Well, look, I've got a unit in the inner west. In fact, I've got two, and they performed incredibly well up to about 2016. And then since then, they've done very little, as you've experienced maybe 10 or 20% growth. I would say, ideally, you want to be a seller into a boom market. So having sat out 8 years of not very much, I would say, maybe there's a potential to sell, but you'd probably want to do it when auction clearance rates are 80% and there's a bit of FOMO in the market. At the moment, things are probably still a bit lackluster. So if you can take advantage of the market cycle a bit more, that would also be useful.
Yeah, absolutely. I think that goes back to the second question we had from Mama Bear, where, if it's not a great market, you're better off potentially just trying to capture that growth and then sell. And so in this situation, I agree with you, Pete. Maybe you're better off just to hold.
Yeah, for a year or two. See what happens.
If that market's got right fundamentals. So we're not saying that it has, because we're not making comments on that, but ultimately you do have to factor that into your decision. So another great episode, Pete. Appreciate. Always look forward to these times every week. Much on this weekend for you?
Not so much. I think fairly quiet for us. We've got a couple of property searches on, but always enjoy the Q&A. So send in your questions, everybody. How about yourself, Chris? Anything on?
No, Dad's up from Melbourne, so I'll be using the extra 4 hands around the house to help out with the kids and get a game of football in, and might do some exploring around the beaches. But
you just reminded me. I think just had to look at my calendar. I'm going to the football on Sunday, so AFL season's here finally. First round got dusted because of the cyclone, so or round zero as they called it. So first home game for the Lions on Sunday, so that'll keep me busy. Fingers crossed for a win.
And I won't be talking about Liverpool. So have a good weekend, everyone.
Cheers. Thanks, everyone.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.